morning, everybody, and thank you for joining us this morning. We have just completed our morning session where the CEO, Mr. Kihara Maina of I&M Bank, had a chat with an online chat under the KBA's CEO 2020 chat. We just want to do a little recap of the discussions that we had over the morning discussion. And Maina Kihara, thank you very much for joining us, and welcome.
Thank you, Anthony.
All right, just to give a bit of a brief, the banking sector through the Kenya Bankers Association has continued to champion initiatives geared towards promoting financial inclusion by facilitating access to credit for all sectors of the economy. The initiatives include the Inuka Enterprise Program, which has continued to build capacity among MSMEs. Now, I won't go too much into this. I just wanted to capture a few of the questions that were shared earlier, just to get a few details. That's what it decided to. Okay.
That's right.
All right. Okay. During the session that we had, there was a question that was brought out where they discussed that the bank is at the forefront of the financial inclusion, and the initiatives that have come up from the individual banks as well as the Kenya Bankers Association standpoint. From where you sit, what do you think needs to be done to unlock other segments of the sector, and expand beyond the lending space?
Thank you, Anthony. I think, first of all, the KBA chat with the CEO series is very, very useful for expanding what the initiatives of the KBA are in actually promoting financial access for everybody in the economy. The particular focus that a lot of people have had has tended to be on lending, in particular credit access to underserved segments of our economy. However, we have to appreciate that actually we need to look at all financial services and how they can actually be facilitated to reach different segments of the economy. So to this end, we need to focus on things like financial literacy, so that people understand how to use financial services, so they can choose when to employ credit in their lives, whether it's in their businesses or in their households, and to do so responsibly. And how else to be able to use other financial services, whether it is insurance that is now increasingly sold through the banking sector, or whether it is just simply promotion of savings and investment.
Okay, thank you. Now, there's a lot of interest around the interest capping that was there, and now with the removal or the repealing of that act, could you please expound on the CBK's banking sector charter and how the banks are implementing the same, especially after the removal of the caps?
So I think the last few years have been a very important period of introspection as a banking sector, to understand, number one, why it was necessary to put in place the interest rate caps, the overarching sentiment behind the implementation of the interest rate caps, and also then to say, so what do we do about it? The initiative that has then resulted is the Banking Sector Charter, which is led by the central bank and has asked the individual banks to actually address several issues through this charter. In particular, they are addressing transparency, addressing fairness to consumers, addressing issues like risk-based pricing, and how we actually can be better trusted, really, as a banking sector when dealing with the public. The initiatives have been taken on and very well received, actually, by the banking sector, and we are working in concert to make sure that we are addressing the systemic issues that need to be tackled, so that we can provide the kind of services that the public is actually expecting from us. Does that mean necessarily lower interest rates? Not exactly, but what one would appreciate is that the rate that they are getting reflects the profile that they have. So we are working together with the credit reference bureaus as well to make sure that the credit scoring that we use is actually well calculated, well calibrated, can be used effectively without having to necessarily incorporate it into yet another score. If you can use it, if it can come ready to use, then it's easy to feed in our models. If we use different channels, particularly digital channels that are increasingly providing access to credit, it becomes easier then to deploy credit because you're not having to rework the scores that you're getting. So all of this work is ongoing, and we expect that it's going to be transformational for our markets.
Okay, all right, very nice. Just the comment on risk-based pricing. This is going to be the new terminology that's going to be coming up quite a bit. Risk-based pricing alongside the Credit Reference Bureau. Maybe just you could expand on who is permitted to access details on one's risk rating?
Well, frankly, anybody who is considering providing credit can request the person who is going to be receiving that credit to give consent so that their credit score can be assessed. Or they can be asked to request the Credit Reference Bureau to send their credit score to the person who's actually looking to provide that credit. So who do I mean here? Well, if a business is providing supplier credit to a customer, they have to be concerned about the ability of that customer to pay. So it makes sense for them to then go to the Credit Reference Bureau with the consent of the customer and see what their credit score is like, because it will give them an indication of the likelihood of that customer to be able to pay up on time. And it would then be included as one of the inputs in determining how much credit you should extend, right? Along with other factors, obviously, that are pertinent to the business that or the customer that is actually borrowing. So it can also be used, for example, by anybody who's providing postpaid services. So any utility, for example, whether it's an electricity company or a phone company, can actually use your credit score to say, well, how much credit can we actually give you, right? So it's not just banks, it's actually a very wide range of different users.
Okay, all right. Well, that's a very interesting point. Now you can obviously see a lot of the industries will start using the credit reference bureaus to give out information or use that information to make credit decisions. There is always the element of women included in the lending space. What is being done? So now more so now that we have the risk-based pricing to bring more women on board in terms of the lending portfolio?
Yes, I think we appreciate that there are social imbalances that we have that have tended to favor access to credit for men over women. And we have to take deliberate steps to address that. And you will have seen over the years that you've got women-centered organizations or programs within institutions that specifically focus on providing access to credit for women and women's businesses. And I expect this trend to continue. I think the trend is really positive. You have to take deliberate steps to make sure that you address these imbalances. And I expect it to continue. We have, as I said, a range of different engagements that are happening, whether it is with multilateral partners, whether it's the development finance institutions, or simply even within institutions, within banks, people looking at women-centered programs to make sure that we address these traditional imbalances.
Okay, right. Just maybe one quick comment in terms of, everybody will now know the credit rating is really important to them. What can one do to have a great credit rating so that my access to credit would now be much easier? Yes,
so I appreciate that this is still a relatively new concept for a lot of our public. And it is important then that we arm ourselves with the knowledge on how credit scores work and where it is likely to be used. Because if we think that it is only going to be used within a bank setting, then we will quickly come to realize that actually it's affecting very many different aspects of our lives, from your access to insurance to whether or not you will be eligible for a postpaid plan, even with power, for example. Now, so of course you have to then think about how the score is calculated. Now, a credit score is really a summary of your credit profile. You appreciate that a credit report will have quite a lot of information. It gathers a lot of data from different providers that talk about any late payments that have happened. For example, if you paid your rent late and your landlord feels that that is information they should share, it will go in there. To any interactions that you make with credit providers, so like a bank, and you want to go and get a credit card, that application will feed into your credit report. Ultimately, all of the information that is gathered is then summarized in a credit score, and it's important to then understand how that score is calibrated and what it then means to your ability to access credit. So what kind of factors drive this? Well, the principal one is that you must meet your bills on time. Pay your bills on time. That is the single most important indicator of whether you are actually a good credit risk. That means all different types of obligations that you have, whether it is the school fees payments that you make, or the credit card bill that you have to pay, your electricity bill, your rent, all of those are important contributors to your credit score. Second contributor is your the balance of your credit. So you have credit limits, you've received a postpaid limit and so on. How much of that are you utilizing? Are you operating at or close to the maximum all the time, right? It indicates that perhaps you are facing certain pressures that may be indicative of a challenge with your finances, and that tends to impact your score adversely. So it's important to then stay within your limits, number one, but perhaps not use them as close to the limit as possible. How long have you used credit? If you start a credit relationship, so for example, you get a credit card, it is good to keep running it for a long time. It indicates that you are able to manage it successfully. You've built up a good credit rating. What about different types of credit? That's also important. You need to demonstrate that you actually understand the different types of credit and can apply them effectively and manage them effectively. So if you want to buy a car, right? Yes, you could go and get a personal loan, right? But it may make more sense for you, for your credit score, to actually go and get a car loan or finance it through asset finance products that banks are offering. If you want to buy a house, yes, you could go and take again a personal loan and manage it. To use an extreme, you could go and finance it using an overdraft, right? But it's more appropriate actually to take a mortgage, right? So using different solutions that are appropriate for the need that you have is also a contributor. How often you go for credit is also an indicator of how challenged you might be with your finances. So if you're constantly going for yet another financial solution, more credit to address any needs that you have, it perhaps indicates that you're struggling to manage your finances. So all of these factors contribute to how your score is calculated, and it is important to understand all these factors. We're not saying that you should game it. You obviously should make sure that you understand these factors, use credit responsibly, and the score will indicate to you exactly how a lender is likely to view you.
Okay, well, very interesting. So that just means pay your bills on time, pay your rent on time, more so pay all your debts on time. So your loan repayments need to be paid on time. Thank you very much for that insight. Maybe just more or less like the last question. What are some of the requirements for an SME to access credit?
Well, pretty much the same principles apply for an established company or a newly established company as well. Essentially, every lender is looking at your ability to generate the cash flow that's going to service the debt that you have. And also looking through to how much capital you have in your business to be able to absorb losses. Remember, capital is really about your ability to absorb losses. So is your company well capitalized relative to the risks that you're taking as a business? That's going to be important to the lender. Is your business model sound, right? Is it actually going to generate the cash flows that you have been saying it's going to generate to be able to pay the loan that you need? What's the amount of debt that you have relative to the capital that you have? Do you need that much debt, right? How is that company then run? Do you keep your books properly? Can you tell when you're making profits, when you're making losses, when you're facing risks, how to manage those risks? All of these factors are really important because we're looking through to the sustainability of the business and its ability, therefore, to service any financial obligations that it has. So these are generally the kind of things that you should look at.
Okay, so ideally one should track all their expenses that the business is making and keep good record, which is really key.
You cannot overstate the need for good record keeping. It will be needed in all sorts of situations. It will be needed obviously even with a taxman, right? When you're demonstrating that you have paid your taxes or how much your tax obligations are, right? And we want as banks to make sure that you're actually meeting your tax obligations as well, right? So it's important to keep records because then it's easier for us to understand the business. You obviously want to get to the stage where you're producing your accounts as a business, having them audited, so it's very clear that the numbers that we are seeing have been validated and that they're telling us then about the strength of your business and its ability to support credit.
Okay, all right. I think I've covered more or less. The only one thing I'd just like to check, I know everybody might be thinking about how soon one gets listed at the Credit Reference Bureau. So what's the sort of timelines?
So typically, whenever you have any delays in meeting your obligations, if we take, for example, a bank, you're supposed to have paid your loan by the 25th of the month, right? Come the next month, or even actually after the 25th, you haven't met that particular payment, that's a trigger, right? And we're now essentially starting the clock and seeing how many days past due have you gone. What that will trigger is a notification to the client that you're running the risk of being listed on the bureau. Eventually, if that accrual or the non-payment persists, then we are obliged as an institution to then report that information to the bureau.